people don't realize, studies and data support that women are actually better investors than men. Fidelity, Robinhood, they've all released reports around this. So there's no reason that more women shouldn't feel confident to enter the stock markets because it is for them as well.
Welcome to Everyone's Talking Money, where we get brutally honest about money, mindset, and making life richer. Let's be real. The stock market looks intimidating on purpose. CNBC's yelling heads, the endless ticker tape, the sea of red and green arrows, it's enough to make even the most financially savvy woman feel like she needs a secret password to get in the door. But here's the thing. The markets were never meant to be a boys' club. And not only do women belong there, we're actually built to thrive there. You're listening to Everyone's Talking Money, the show that's all about making life richer, from your bank account to your mindset and everything in between. Whether you're here to crush debt, grow wealth, or finally feel in control of your cash, you are in the right place. Let's dive in and get you living life on your terms. You are one conversation closer to financial freedom. Today, we're pulling back the curtain on a part of wealth building that most people write off as too risky or too complicated: trading. And my guest, Diana Perkins, is the perfect guide. She's a CPA, investor, and founder of Trading with Diana, where she helps women step into the markets with clarity, confidence, and zero intimidation. With more than 20 years of experience and a refreshingly human approach to money, she's here to show us that trading isn't just for finance bros. It's a tool you can use to grow wealth, build independence, and create more options for your life. We're talking about the biggest myths that keep women from trading, how to manage your emotions so you're not sabotaging your own strategy, what you actually need to get started, and why financial literacy might be the most underrated form of self-care out there. So if you've ever looked at the stock market and thought, this is not for me, this conversation is your invitation to think again. You make money feel approachable instead of intimidating. When you look back, what sparked your passion for helping women build confidence in trading, and why do you believe this work is so needed right now?
Thank you so much for that question. I will say I've always taken a very pragmatic approach to investing and money throughout my life. And one of the things that I learned through my career in finance and through running my business, as I spoke to more and more women about money, I realized that emotional connection to money and the limiting beliefs around money. And I feel that women have been left out of the conversation around specifically the stock markets, but around finance for far too long. And so that's why I've created specific programs catered and tailored specifically for women to help build that confidence and that know how and inclusivity in the stock markets, in trading, in wealth building, because it's like I said, it's been far too long that women have been left out of that conversation.
It's so true. It seems like everything about trading and the stock market, news channels, writing, anything is so male dominated and it's in such a male voice, likely because a male was writing it, right? Because there's so few women in financial services as it is. So likely those that are creating the materials or creating the information are going to be male. But men and women speak a different language when it comes to money, when it comes to investing, risk, and all of that. But even like if you were to turn on CNBC and like picture you have two TVs and one's CNBC and one's like ESPN, right? They look pretty similar to each other, from the aesthetics to the talking heads to the passion behind it. And it's like, no wonder why women are not turning on CNBC to keep up with what's going on in the stock market, or they feel intimidated because they don't see anyone that looks like them talking back to them. And I think that that's one huge barrier of entry, is that just like what the channels, what we're viewing is not for women at all.
I completely agree with that. And even just to take it a step further, and I can tell you from personal experience, there are some challenges that women do face in those arenas that our male counterparts may not. And so I'm on a mission to debunk those myths and change the face of what success in the stock markets look like. Many people don't realize studies and data support that women are actually better investors than men. Fidelity, Robinhood, they've all released reports around this. Now, granted, it's around 0.4% or 40 basis points for my financiers out there. So it's a small amount, but it's real and it's different than what a lot of people think. So there's no reason that more women shouldn't feel confident to enter the stock markets because it is for them as well.
Yes, I remember when Fidelity came out with that study. And again, it's women are not doing heads and tails better than men as far as investing goes. Like you said, it's 0.4%, but better is still better. Or like even we're even. Like it's even Steven. And that's as much of a story too. Because if we were to ask women on the streets, like, hey, who do you think has a better portfolio or in general can manage their money better, I would be surprised if the majority of women we asked said women, right? But this study is showing that we're slightly better, but the story is like we're even, we're doing just as good. So we should have the confidence because the reasons why we are doing just as well are the strengths, where I think we often view it as weaknesses. We don't necessarily we don't have the we're not just diving in head first. We study and we research, generally speaking, as women. We study and we research and we want to understand what we're doing, and we're not reacting with emotion once we're in the investment and once we have our money working for us.
That's right. And to add to that, I mean, when you talk about the emotions in trading, I like to talk about the stock markets in terms of organized chaos. It moves on greed and fear. But anyone can learn the rules, but it's that emotion. It's 80% psychological, right? That's really the driving engine. And when we look at women in the markets, just like you said, that diligence, a strategic mindset, less impulsiveness, talk about emotions, less impulsiveness. Maybe not all women are as risk averse as we hear in the stereotypes. Because the truth of the matter is, I mean, I work with men and women, and it is for everyone. And I think it's just that psychological barrier that we need to get past so we can all benefit from the stock markets because let's be real, that's where the money is.
Well, and I believe it's 94% chance that women are going to be the sole financial decision makers for themselves at some point in their lives, whether it's due to never having a partner to manage the money for you, or a widowhood, divorce. So it is important for women to have the confidence to be able to bring on some of these financial matters and manage them themselves, and or find the resources that can help them. Not everyone, not every person, not every woman is going to turn on CNBC and be like, I can't wait to see what the markets are doing or what the futures are. I can't wait to see that. That's the best part of my morning. No, that's crazy. And for us to expect that out of someone where that doesn't come naturally, that interest isn't natural, but at least having some understanding of it is so important, because you need to understand where your money is and what it's doing. And again, if everything's left, if you have a trusted resource and they're in the end making a lot of the calls for you, at least you know what's going on and you can ask questions and you can feel comfortable and confident in what you have.
Absolutely. And that educational piece, I mean, that's really the first step. Even if you never place a trade, even if you're not actively investing in the stock markets, understanding the terminology, what moves the market, and just being part of that conversation, it is so empowering. But there's something coming called that's being dubbed as the Great Wealth Transfer. In 2048, right, in about a little over 20 years, $24 trillion is expected to change hands, with 70% of that going to women. To your point, maybe there is someone that's managing your finances today, whether it's an advisor, a partner, spouse, maybe there isn't. But going forward, we want to get ahead of that transfer so that every person, male or female, feels confident and knows what to do with that money when they receive it, whether it's a short-term fund, paying off debt, or investing for longer-term wealth.
All right, we're going to take a quick break. But before we go on, do me a favor. If this episode is giving you those, I can totally do this vibes, share it with one friend who needs that same energy. Seriously, we all rise together. While the ads are playing, just hit that share button. Super easy. And your friend, trust me, she's going to appreciate it. So you had money instincts rather early on. You likely were born with it, or money was a comfortable subject in your household. And because you were charging your sister interest at 9 years old and you were negotiating car loans at 18. Did those instincts shape how you trade today, or did you have to unlearn some habits along the way?
Oh, that's a good question. And I will say, growing up, money wasn't a big conversation. Although we were raised with the perspective, figure out what it is you want to do with your life and then do that. So I have a sister who's an artist, one owns a tiki bar, and then I'm a trader. So that was the mindset going in. So you're right. It was just this natural inclination. I always loved numbers, the perfect science. Obviously, I'm getting excited just talking about it now. Now, in terms of habits to overcome, the way I started, it was automatic transfer. I was in my early 20s. I grew up in the Midwest. All my friends were getting married, having children, and that's how I funded the bridesmaids dresses, the travel, etc. But then as I moved into my late 20s, early 30s, the weddings trailed off, the babies trailed off, and I started building this nest egg. And at that time, it was a savings account. I later opened a brokerage account in my mid 20s and then built wealth from there. So I'll say early on, it was automated, easy breezy. When I started actually trading and learning about the stock markets and building wealth that way, there were definitely barriers that I had to overcome, even as someone who does wake up and get excited about the futures markets and CNBC every day. I'm like, oh my God, she has me pegged. Even as that, I'll say, when I started, I was trading the Burbs Capital for a profit split. And I was worried. I didn't want to lose their money. And I learned you need money to make money. And I need to put that fear aside. I remember, losing out on some trades and I got a little annoyed. I did my due diligence. I had my strategy. I had my 15-page trading plan with matrices, yet I still lost money. And so I did what we call revenge trading. So I've been through a lot of those things. I've placed trades backwards. And I always tell my clients, my traders, my students, there's no substitute for experience. I've been through them. I could go on about it. But so yes, we've all been there.
So let's even start at the very beginning. When you say trading, what are you referring to?
So when I talk about trading, I'm talking about buying and selling a share of stock. So people might call it investing in the stock markets. To me, investing's more longer term. So with trading, I typically hold positions. So say I buy a share of Microsoft. I'll hold that position typically around 4 to 5 weeks. We call that swing trading. It's kind of that sweet spot between day trader in and out in a day and a long-term investor where you buy and hold maybe for a year or more. So when I talk about trading, it's that sweet spot, that swing trading. You're basically capitalizing on market price swings. That's what we call it.
So that helps because we hear investing all the time, but that's generally for a long-term focus, whether it's retirement or a longer term goal, longer than a year. So trading is more active. So we're taking more of an active approach in our investing, buying and selling different stocks in that 4 to 5 week sweet spot, like you mentioned, because I think everyone's heard of day traders before. So that's just, trying to make money in a day, buying and selling a stock within a day or two, but then long-term investing. But what you do and what you focus on is kind of that intermediate, like you mentioned. So for people that just sounds way too intimidating. What's the biggest myth that keeps the average person that you work with from even trying to start trading?
I think so there are a lot, but number one is I don't have enough money to start. Well, I don't know where to start, but I don't have enough money. I don't have enough capital. I think a lot of folks feel that the stock markets, it's just for Wall Street or the quote unquote finance bros. But the reality is that many online and we call them brokerage accounts, that's where you buy and sell share stock. brokerage accounts, think Fidelity, Schwab, Robinhood, E-Trade, eToro, there's many of them. Many of them have $0 account minimums, meaning you can open an account, zero cost, and you can start trading or investing long term with $5 or $10. So really trading with online brokerage accounts, $0 account minimums, and starting back in 2019 with Robinhood, and then the other online brokerages followed suit. $0 commissions on stocks and what's called ETFs or exchange trade funds, meaning you open your account for free. You have $5, you place a trade, and you're just paying. It's just really small, just like pennies, very small fees, no commission. So it's the barrier to entry. It is so small. So I would say that's probably number one. Is you don't need thousands and thousands of dollars to get started.
What are some other myths that are keeping people from doing this or participating in trading?
Yep. So some other myths are, so the way I describe swing trading, and you bring up a good point that could sound very intimidating, probably to most listeners. So another common myth is I don't have enough time to trade. Now, what I teach, so personally, I swing trade. What I teach, you can day trade or you can invest for long-term wealth. And when I had those auto transfers, that's exactly what I was doing. I didn't touch those funds for years. And I looked at my account, and I'm an ex-auditor, and I audited those numbers, and they were right, and they had grown quite a bit because I was also getting a dividend. Anyway, so my point is the other belief, I don't have enough time. So once you open your account, you fund your account, you can invest, daily, weekly, like I do, or you can put your money in what's called an index fund that follows like the S&P 500. You just invest in 500 of the largest companies in the US, and you set it and forget it. And you let it sit for years on end. And on average, as I'm sure you know, since the inception of the S&P 500, the inception of, how we track these companies and their performance, the index has returned around 9.5 to 10% over time. Not every year, but over time. So there are strategies, which we'll call passive investment strategies, where you open your account, fund the account, place your trade, and you walk away. So you can absolutely do that. Just make sure you're managing your risks. And that would probably be the next the next fear is losing money.
Yeah, so an ETF, as you mentioned, is called an exchange traded fund, and they were created to essentially mimic an index. So because 30 plus years ago, before ETFs existed, and you were watching all the talking heads on CNBC, and you see the red and green Dow, S&P 500, and you would see it be red or green and up or down and all these numbers, and it's like, oh, S&P's up, S&P's up. You couldn't buy the S&P 500. It was a way to track, as you mentioned, the 500 largest companies in the US. So you couldn't buy it because it was just a bunch of stocks, 500 stocks that were being measured. So then ETFs were created that essentially put all of those stocks into a nice pretty package, and that way you could buy that was the way you could buy the S&P 500 and without having to buy and trade 500 individual stocks. ETFs are really great for getting super diversified very quickly. And like Diana said, like you can just hold on to them for an extended period of time and know you're diversified. And the stocks that are in the ETF will change as the stocks in the S&P 500 change. But on that, Diana, talking about if we were to stumble upon CNBC one day, can you explain what we are looking at when we look at that? There's stuff scrolling at the bottom, then there's usually something staying in the lower right-hand corner, the Dow, the S&P. We talked about the S&P, but what are some of these indices that we look at, and why do people get so excited about them?
That's a great question. It's a great starting point too. So yeah, so when you turn on your TV to CNBC, across the bottom, you'll see what's called it's a ticker essentially, and ticker screen. And what you'll see is you probably heard the term, many of the listeners probably heard the term, broad market. The broad market's going up, or the broad market's going up, market's going down. And typically what folks are talking about is the S&P 500, which we discussed. So 500, the largest companies in the US. The NASDAQ, which it's over 3,000 stocks, and it's just another index. And it's tech heavy, about 60 to 70% tech stocks. So it tends to move more volatile, bigger price shifts. And then you have the Dow. It's probably the other, and there are others as well. But the Dow, 30 stocks, blue chips, kind of like mom and pops, across different industries. And so across the bottom, the red and green that you see, you'll definitely see those three across the bottom. And red means that those indices are going down, and they each have different ways that they're calculated. So that's indicating, okay, with the S&P 500, I have 500 plus large companies that we're tracking. Um, Overall, the index, it's down. So it's red. So you might want to sell into that, might want to wait. Sometimes it entices fear, but that's all it means. It's just going down a little bit. It's very normal. Green means that the index has risen. And so it's really almost like a health check of how the market's doing when we look at these really large companies across different industries. They'll also show, we've mentioned the futures markets, which gives us a sense, well, how's the market going to open? Is it going to open up or down? You know, we'll see there are other indices down there. There might be crypto, there might be cryptocurrencies, so digital currencies like Bitcoin. And then there also might be like commodities markets. But each one that you see, just remember, red, the index is going down, green, it's going up. And it just gives you a sense and a pulse for the markets and the health of it's almost like an economic indicator.
Thank you for that. And I think what's important to remember or keep in the back of your mind is the way that they report it, red or green, it kind of can prey on your emotions because the Dow right now is valued at, when we're talking today, 34,890.09. That's what it's currently valued at. So think if you had $44,890.09. Okay. And right now it's down slightly. It's down, it keeps on switching, but it's down 22.69 and it's red. Well, we could end the day and it could end at 0.01, down 0.01, and you're still going to see it's red and there's going to be a down arrow. That's essentially equivalent to if you had $44,890 and someone took a penny of it, would you be that upset? Probably not. You're going to get a down arrow, whether you're down zero point zero 0.01 or down 401. It's always this, it's either going to be red or green, no matter what. So it's important to look at, well, the market's down, the market's down, market's down. How much of it is it down? How much? Because every day, it could be down 5 days in a row, but in the grand scheme of it, it's really not down that much. But the news is going to flash down market, it's red, down arrows, and make you freak out like something terrible is happening. So I think it's always important to keep things in perspective because, like everything, the headlines want to create a reaction out of you. They want you to get emotional about it. Just look a little deeper, look at the numbers because they're going to tell you how much everything's down by and put it in perspective that way because we definitely don't want our emotions to get the best of us when it comes, especially when we first are starting out with investing. It's super important to just understand what you're looking at so your emotions don't get in the way of your strategy. Diana, it's time for our money confession segment where I ask you some real deal questions about money and you just answer as openly and as honestly as you can. If you were gifted $1,000 and you had to spend it today, no saving, no investing, what would you do with it?
Hands down, traveling. I lived in Europe for 4 months in college. It's my happy place. So I would definitely use it to travel.
What's your most rebellious money move? Something a financial expert might cringe at, but you'd do it again in a heartbeat.
So when I was an expert trader, and I was trading full time, I was working with a lot of traders who are aspiring professional traders, and almost every single one that I spoke with had blown out a trading account entirely before they came to me. And I used to say it was their rite of passage. So at that time, I had 3 accounts that I was trading, and one of them I purposefully ran it from, and I'll just tell you the number, it was $20,000, so enough to sting, but not bankrupt me, all the way down to zero. Because I wanted to understand from a psychological standpoint what my traders, like what they felt, what they were going through. And I will say I doubled it first. And then, and it was just one day on a call, I, put it all on one trade. And I felt free after that. But I will say that is very controversial. I don't, recommend it. But for me, it was an experiment to put myself in the shoes of my students so I could be a better coach. And again, I could afford to do it at the time.
Wow. What's one money habit you've completely ditched and why?
I would say while I tend to be more, I think, prudent when it comes to money, maybe than most. I do believe in self-care. And I will say there have been times where I spent a lot of money on retail therapy, we'll say, and treated myself. And I would say it's not something I do very often, but I see it as an investment in myself, and I've never regretted it.
If money were to show up at your doorstep, what would you say to it?
Come on in. Yeah, you're welcome. I've been waiting for you.
And Diana, you talk a lot about the psychology of trading. So, for those that are super logical at work, but emotional when trading, or super logical at life, even, what's a practical way to separate feelings from the strategies?
Excellent question. And I also love your nuance around the market swings. Some people might even dub CNBC as finance entertainment. It's that Chicken Little effect. The sky is falling, but it's really not. Or reaching new market highs, it's going to turn over. We reach market highs, I think 7% of every trading day since like 1950. So just wanted to mention that. But yes, in terms of managing your emotions, to say you want to get started investing in the stock markets, just buy and hold, but you're worried, right? So the best way to stay grounded is to have a plan. I always say plan your trade and trade your plan. And in that plan, when you begin, you'll want to outline, well, these are my goals. So maybe each year I want to grow this account by, say, 10% or 20% in a year. And I'm going to achieve this by investing in these types of companies or these types of indices so I can stay diversified. I'm going to enter at this point, I'll exit at that point. You'll also want to have a plan around, and this is probably honestly the most important aspect of your plan, is risk management. So a rule of thumb, any single investment or trade, no more than 1 to 2% of your account. You should never, no trade or investment should ever keep you up at night. You never want to take the big loss. You want to be diversified, which means you don't put all your money in one stock. We call it single stock risk. So you want to have your goals. You want to define what you're investing in, and you want to define, okay, how much risk do I feel comfortable with? And it is so personal. Investing is so personal. So to you, it might be, $100. To your neighbor, it might be $1,000. So for you, there is risk involved, but there's also the reward on the upside. So understanding, okay, this is my time frame, this is what I'm investing in, and this is how much risk I'm willing to take, and come back to that plan, and that will help you stay disciplined moving forward.
If someone's earning well and they want to dip their toe into trading, what's a realistic amount of money they should start with? And I know it's everyone's different, but there also is like a reward factor. If we're starting off with like $50 and we make 10%, it's $5. Yes, that's great. We made $5 or made 10%, but impact may not be as great. So do you think there's like a magic number to start with if someone has liquid assets that they want to start investing, a good number for them to start with?
So you were right when you said it does vary. I will say, and this is the CPA in me, don't trade or invest anything you can't afford to lose. So I'll take the prudent measure to start. But you're absolutely right. You need money to make money. I mean, I have a client, he sold a nice piece of real estate, 20%. He'll be making six figures every year. So I'm helping him get to that point. Now, if you're just starting off, and I'll quote from the book Market Wizards, when you first start, it's the worst trader or investor you'll be. You'll make mistakes. Like I mentioned before, I know I made my fair share. So you'll want to start small. So it could be starting with maybe $5,000, $10,000. So you can get, some real return, a couple $100, get your feet wet. And then once you feel comfortable, you can add money to that. But I would definitely recommend start small, see what you feel comfortable with. One thing I'll mention is so a lot of people I'm realizing don't know about this, but a lot of brokerage platforms, so Schwab, Fidelity, E Trade, off the top of my head, they have what's called paper trading or simulated trading accounts. So you can open an account with one of these firms, one of these companies, and you can practice trading and risk $0 just to get comfortable with the platform. Then fund your account with, like I said, maybe five, $10,000 to start, get your feet wet. And then as you build that confidence, you can bring in more money.
You mentioned before that your trading is like 4 to 5 weeks, is generally how long you intend on holding on to a stock. Well, what happens if you buy it and you do the research and it's like, it's just tanking? Do we hold on to it for a longer period of time? Do we take the loss? Because sometimes losses aren't a bad thing. And I know we're going to get super into the weeds with that comment I just made. Does a short-term investment sometimes turn into a long-term one?
So, yeah, so this is a really good question. So, the reason that for me, 4 to 5 weeks is my sweet spot is because I trade stock options, which are called derivatives. So, there are different strategies where you can optimize your return in around that time frame. So, I do have a trading plan. It is 15 pages with matrices, and for every single strategy, I have a time frame, my entry, my exit, and I follow it to its. I will admit I may be, or at least at one point in my life, I was disciplined to a fault. But then I remember, there are revenge trades, there are a few slip ups, but for the most part, I do my due diligence, I set my trade, and then I let it go, and I trust the process. I think where a lot of traders and investors get hung up, they're looking at their P&L every day, just like what you were saying before. No, I lost $5. Good, I'm up $20. Don't do that to yourself. It's number one cause over trading. It's why I think 95% of day traders lose money. Trust the process and the rest will take care of itself. So you have your process, manage your risk. So no, I follow my plan. But like I said, it's very individualized. So you'll want to follow yours as well. And what you mentioned, and you're right, we could get detailed about this, but on the losses front, and you said it too, managing your expectations. It is natural, right? There is risk in the stock markets, in investing. And you never want to hold on to, a losing hand too long, so to speak. I'm also a poker player, right? You never want to hold on to it too long. So you define what that risk is up front. And if it pulls back, that's okay. That's natural. If it pulls back to that point where it's beyond that 1 to 2%, you'll be out for a small loss. You have a price target, you'll be out for a win. You just want to make sure that your winners are making more than your losers. There are ways to do that. And then you should come out ahead. So that's actually the formula at a very high level.
So when you're doing this trading and you're making money, and sometimes you're making money, sometimes you have winners, you have losers, like you said, but come March, April of next year, you have to report to the tax man, right? So we need to start reporting these wins and losses. So can you talk a little bit about that and what someone can expect if they start trading themselves when it comes to tax time?
Yes. So, right. So when it comes to taxes, and this is an excellent question. So when it comes to taxes, so you'll receive statements in the mail from your brokerage accounts, however many you might have, more than one, and it will outline all of your gains and losses from your trades. Now, you will pay capital gains tax on your winners. So if you held for more than a year, get longer term, it's definitely a better rate than shorter term where you're in and out like I am every 4 to 5 weeks. That is that tax provision. That is something that you will want to plan for. There are strategies, for example, tax loss harvesting, where you can liquidate some losing trades to offset some gains others. So there are different strategies that you can use to lower that tax bill. But it's a great question because many folks, where they start is they're investing in an employer retirement plan, for example. That's where they're building their wealth. And those are tax advantage plans where you don't have to think about, these implications. So it's like that risk reward teeter totter essentially. You have the opportunity for much greater returns in a shorter time frame, but just know, right, a piece of that you will be giving back to.
Yes, always if you find you're making money, definitely set some aside because Uncle Sam's gonna have his hand in it eventually. Sooner or later, he's gonna have his hand in it. You have said that financial literacy is a form of self-care. So for women who outsource or they don't participate in their finances, what's the case for taking control of their own not only financial education, but their investments and how to make money?
Absolutely. So I will say over the years, working with and especially with women for the reasons we talked about before, is just that mindset. There's often a lot of anxiety because finance, it can be very complex. And if you're not knowledgeable about how the market works or how, what you're invested in, it can be intimidating. And I think sometimes there's this facade where it's meant to feel intimidating. So the case there, the argument there is I always say when it comes to finance, ask as many questions as you need to until it's black and white. And when I say, when I talk about self care, it can create a lot of just anxiety. Where is my money? Do I have enough to cover debt? Or just even thinking about your day to day cash flow. Do I have money to invest? And the more that you can learn, this is where my money is. This is why it's invested where it is. This is how accessible it is. Now, looking at the future, I want to, retire on this. I have this already, saved or invested. Maybe there's more room. How do I do that? And if you have a financial advisor, ask him or her those questions. If you do start trading, there's so much good educational information out there. If you're not ready for a coach yet, there's so much great free information out there as well. But educating that they say the greatest antidote to fear is action. So when you have these fears around finance and money, do a little bit of research. Investopedia is a great resource. You understand some of the terminology and ask questions until it's black and white. Because to your point earlier, 94% of household investing decisions will fall on the shoulders of women. And the more you know, the more confident you'll feel, the more empowered you'll feel around your money. And that's really, it's will go around, not to be too cliche, but it's just such an integral part of our lives. There's no excuse not to.
What was the turning point for you that you took this from saving automatically weekly, biweekly to and trading and investing to, I can make this my career. This is what I can do every day.
Yeah. So there's a little bit of a story around it. When I was 20, junior year in college, that's when I first learned about the stock market. And we had this virtual stock exchange. As you can imagine, I was obsessed with it. And I came in 11th in our class, which I thought was okay. Anyway, but I knew this is what I wanted to do, but on my own terms. Fast forward, it's about 10 years into my corporate career, got my CPA license, auditor, nice and safe. And I came across this letter that a family member had written to me during that year when I was taking that class. And the letter was attached to an article from a periodical called the London Review of Books. It's about this theology professor who switched into options trading. And the letter that this family member wrote to me, he said, I want you to read this article cover to cover and put it at a level higher than any paper you will write or test you will take, for this is your future, I'm sure. And he wrote, it's contextualized. And I remember reading that, and I was thinking at the time, in my CPA, maybe I'll get my MBA. And that's when I left my corporate career. I was getting ready to be promoted director for a $3 billion company in Chicago. And I joined this what they call a proprietary trading firm, learned how to trade stock options. And that's when I worked with hundreds of traders. And it was the best part of my day. I mean, it still is, and that's when I knew this is what I wanted to do, and I knew most people. I have 4 older sisters, none of them like finance, none of them like numbers, but I know how powerful this is, and I knew if I could reach others and help them build wealth in the stock markets, even if they hate it or they're intimidated or they don't know where to start, then I'm onto something, and so that's when I created a pilot group, and it was very successful, and then I left my consulting career to do this full time.
As we wrap up, if someone's listening today and they feel curious about trading, but also understandably a little scared or intimidated, what's the one mindset shift or first small step you'd want them to take after hearing our conversation?
I would say just know that the financial markets, the stock markets, they are for you. They're for everyone. Like I mentioned before, I think a lot of people just feel left out or it's not for them. But just know it's accessible. It's very low entry to get in. And just start with that first small step, build confidence from there, and then take the next step, just like you would with anything else in life. Take greatest antidote to fear is action. Just take that first step.
Here's the bottom line: trading isn't about timing the market, predicting the future, or suddenly becoming a Wall Street genius. It's about building confidence, making informed decisions, and using one more tool to grow the kind of wealth that gives you choices. Diana said it best: the markets are for you. They're not reserved for men in suits or people with millions of dollars. And the biggest shift you can make is simply deciding to step into the conversation, even if you start small. If today's episode gave you that spark of "I can do this," then consider that your cue to take action. Maybe it's opening a free brokerage account. Maybe it's learning a few basic terms. Or maybe it's just committing to understanding where your money actually is and what it's doing. Whatever that first step looks like, take it, because the confidence and control that come with it, that's priceless. And before you go, a quick reminder: follow Everyone's Talking Money on your favorite podcast app so you never miss an episode. Leave a quick 5-star rating and review. It helps us reach more women who are ready to build wealth on their own terms. And come keep the conversation going with me on Instagram at Everyone's Talking Money. Because at the end of the day, money should be a tool that lets you live life on your terms. And this is one powerful way to make that happen.